Imagine waking up, right, and finding out that the biggest single operating expense for your business just spiked by like more than $2 billion.
Oh, man. Just overnight, basically.
Literally in a matter of months.
Yeah.
For almost any company on Earth, that kind of macroeconomic shock is just, I mean, it's a death sentence.
Yeah. Or at the very least, you're looking at a guarantee of severe unprofitability for the year.
Exactly. And in the past, if you told Wall Street that an airline was about to swallow a $2.3 billion year-over-year increase in jet fuel costs, driven by all those severe geopolitical tensions and the closure of the Strait of Hormuz, I mean, the consensus would be to brace for an absolute bloodbath.
Oh, definitely. You would expect defensive posturing, slashed guidance, and frankly, a lot of apologies from the executive team.
Right. But today on Talk Tickers, we are breaking down the United Airlines ticker symbol UAL second quarter 2026 earnings call.
And we're going to give it to you straight. Plain language, hard numbers.
Yep. And a definitive verdict on what these results mean for you, the retail investor, whether you're holding or just considering the stock.
Because the historical precedent for airlines is that they are hyper-cyclical, right? Just highly vulnerable commodity businesses.
The old rules of economic gravity basically said if oil prices surged, airline margins were instantly crushed.
And if the consumer economy even hinted at a stumble, leisure travel just evaporated.
It was always a race to the bottom on ticket prices. They had a virtually zero buffer against external shocks.
But, you know, what we're looking at today suggests a potential paradigm shift.
Okay, let's unpack this. Because despite massive industry headwinds, UAL just dropped a print that demands serious attention.
Yeah, they really did.
I mean, they didn't just survive that $2 billion fuel spike, they absorbed it.
And managed to post numbers that actively challenge all those traditional assumptions we just talked about.
So let's start with the headline numbers, the top and bottom line.
Let's do it.
Total operating revenue hit an impressive $17.7 billion. That is up 16% year over year.
Which, I mean, growing a revenue base of that magnitude by 16% in a single year is wild.
Especially in a mature, capital-intensive industry, you need a massive catalyst for that.
You really do. But the profitability metrics are where you get a clearer picture of their operational control.
Right. So earnings per share, or EPS, landed at $1.99.
And to contextualize that, when management gave their forward guidance to Wall Street earlier in the year, they projected an EPS range of $1 to $2.
So they basically maxed it out.
Exactly. Delivering 1.99 means they didn't just meet expectations, they hit the absolute ceiling of their own guidance range.
With a pre-tax margin sitting at a very healthy 4.8%.
Which brings us back to that initial shock. Hitting the upper limit of your own earnings forecast while carrying an unexpected multi-billion-dollar cost burden is, well, it's incredibly difficult.
Yeah, it's like imagine running a personal best in a marathon, but someone strapped a 50-pound weighted vest on you right at the starting line.
That's actually a great analogy. The corporate structure has to be optimized to an extreme degree to pull that off.
So how did they carry that weighted vest?
It comes down to a metric called TRSM. That's TRASM.
Right. Total revenue per available seat mile.
Exactly. And for this quarter, their TRSM increased by 12.1% year over year.
Okay, so let's translate TRSM into plain language for everyone listening.
Basically, unlike a retailer selling, say, shoes or electronics, an airline's inventory is completely perishable.
Right. Once the plane door closes, an empty seat makes zero money forever.
So the fundamental unit of inventory is the available seat mile, or ASM. One empty seat flown 1 mile equals 1 ASM.
So it's a measure of capacity.
Yes. And TRSM takes every single dollar the airline generates tickets, baggage fees, cargo, loyalty programs, and divides it by that total ASM capacity.
So a 12.1% increase means United is making significantly more money for every single unit of real estate they put into the sky.
Exactly. It shows massive demand.
It's like a grocery store figuring out how to make every inch of shelf space generate 12% more cash without making the store bigger.
Right. And they aren't doing this by just jacking up prices on empty planes. The load factor actually ticked up slightly, too.
Load factor being the actual percentage of seats filled by paying customers.
Yep. And that combination is the dream scenario. Usually, if you aggressively raise fares, you destroy demand.
People balk at the prices and stay home.
Right, but TRASM went up double digits and load factor stayed strong. It shows highly inelastic demand. People paid the higher prices anyway.
Wow. And looking at the regions, domestic TRASM was up 12.2%. But international was huge too.
The Pacific region was up 14%, and the Atlantic was up 12.1%.
Those are historically high barrier, high margin routes, right?
Absolutely. You can't just spin up a startup airline tomorrow and fly Chicago to Tokyo.
Yeah, that takes massive capital.
So United's dominance there insulates them from cheap domestic fare wars. It's a lucrative baseline.
Even cargo was up 22.6%, though management said that was yield-driven, not just volume.
Right. They charge higher rates for the same amount of freight.
Makes sense with global shipping routes disrupted. Air cargo becomes a premium necessity.
And you can only charge a premium if your service is reliable. They had their lowest Q2 seat cancellation rate in company history.
And their highest net promoter score since the pandemic.
Exactly. If you're paying $2,000 for a ticket, you're buying the certainty of arriving on time.
Which leads to the logical follow-up. How did United pull off record numbers and raise fares without getting undercut by discount competitors?
Right. In the past, a budget airline would swoop in, offer a dirt cheap ticket, and steal the market share.
So what changed?
This is where we get into the story behind the numbers. Management highlighted this industry shift they called cost harmonization.
Cost harmonization. Okay, that sounds like peak corporate jargon.
It really does, but it's arguably the most important macro trend in airlines right now.
Break it down for us.
It means the foundational expenses to run an airline have violently converged for everyone. Airport fees are up 60% since the pandemic.
Landing fees, terminal rents, those hit every carrier equally.
Plus, the massive recalibration of labor contracts. Pilot shortages led to historic pay increases across the board.
Right, so a pilot flying for an ultra-low-cost carrier is now demanding pay close to a United pilot.
Exactly. So if your entire budget business model relies on keeping underlying costs incredibly low so you can sell a $30 ticket.
The math just completely breaks.
Yes. Your pilot costs doubled, airport rents surged, maintenance skyrocketed. You physically can't sell a $30 flight anymore.
The structural floor for unit costs got forcibly raised for everyone.
Which forces weaker airlines to lose money or cut routes. And when discount carriers have to raise prices to, say, $100...
it gives premium players like UAL the economic air cover to raise their own fares.
Exactly. If the price gap narrows, consumers will just choose the airline with better service and reliability.
That makes total sense. And the data shows it. 4 of the 8 publicly traded airlines are expected to lose money this year.
And we've already seen one carrier enter bankruptcy.
But interestingly, management argued that despite higher yields, air travel is still historically cheap.
Yeah, adjusted for inflation, airfares are actually 13% lower than they were prior to the pandemic.
I mean, that's hard to believe when you're booking a summer trip.
It is, but mathematically, airfare hasn't kept pace with the inflation of groceries or housing.
So UAL has runway to keep incrementally raising prices, but they're also doing something else. They're decommoditizing the airline seat.
Yes. Historically, seats were just interchangeable commodities. You'd go online, sort by lowest price, and buy the cheapest one.
Saving $20 was more important than brand loyalty.
But United is aggressively pivoting away from that. They want to be a premium lifestyle brand.
And it's working.
Yeah.
Premium revenue was up 16.4%.
And TRASM for their high-end cabins like Polaris grew by 13.6%.
The chief commercial officer called it a trifecta of demand. They're seeing surges from corporate travelers and high-end leisure travelers at the same time.
People are just more willing to spend discretionary income on travel comfort post-pandemic.
And United is spending big to capture that. They're rolling out Starlink Wi-Fi to 1,000 planes by the end of the year.
Which is a game changer. Legacy Wi-Fi is terrible for streaming or working.
But Starlink is low Earth orbit. High speed, low latency.
And their customer satisfaction scores on Starlink planes are literally double the rest of the fleet.
Wow. If I know I can actually work on a United flight, I'm definitely bypassing a slightly cheaper competitor.
The Wi-Fi becomes a core utility that drives booking behavior.
And that digital ecosystem ties perfectly into their loyalty program, which is just printing money.
Loyalty revenue was up 11.3%. Co-branded credit card accounts hit a record, up 22%.
Okay, let's explain how the credit card thing actually works for retail investors.
Right, because you just see points in your app. But basically, it's a massive currency exchange.
Chase Bank buys mileage plus miles from United in bulk, right? For billions in cash.
Yes. And then Chase uses those miles to reward you for spending on their card.
So United gets paid in hard cash by the bank way before I ever try to redeem a flight.
Precisely. And the margins are exceptional. Plus, mileage plus enrollments grew by 9%, outpacing physical capacity growth.
Which builds a captive audience. If I have United status and lounge access, the switching costs are too high. I'm ignoring the discount carrier.
What's fascinating here is that United is behaving more like a sticky subscription-style lifestyle brand than a traditional transporter.
And they're using digital merchandising to upsell too. They called it nested selling.
Basically applying the Amazon checkout model to airlines. Instead of a confusing list of fares, they dynamically suggest upgrades.
For a little more, you can skip the middle seat and get lounge access.
And it's working perfectly. Premium buy-up rates exceeded their projections.
But you need the physical planes to support those upgrades, which is why they're focused on upgauging.
Right. They're bringing in Airbus A321neos and the Boeing MAX 10s, which have a much higher percentage of premium seats.
The MAX 10 is crucial because it holds more people, but shares commonality with the rest of the 737 fleet.
So pilot training and maintenance are standardized. It maximizes revenue while keeping unit costs incredibly low.
And they'll need those premium seats because corporate business travel is back.
Contracted corporate revenues were up a remarkable 27% year over year.
Big multinational companies are finally putting their road warriors back in the sky.
And United is holding back more inventory for close-in demand to capture that.
Meaning they refuse to sell a cheap seat a month in advance, betting a business traveler will pay 4 times as much 3 days before the flight.
It's risky, but their stable load factors prove they have the visibility to pull it off.
So that's the operational story. Q2 was great, but Wall Street is forward-looking. What did management say about Q3 and beyond?
For Q3, they expect EPS between 2.50 and 3.50. But the big news is they tightened full year 2026 EPS to the high end at $9 to $11.
Wait, I have to push back here. Didn't fuel prices just spike again in July? Are they hiding that risk?
It's a fair question, but actually they are leading the industry in transparency here.
How so?
They explicitly baked a 15 to 20% July fuel price spike into this new guidance.
Which translates to what, like a $1.12 EPS hit?
Exactly. They embedded that massive penalty directly into the $9 to $11 projection.
Oh, wow. So they're setting a worst-case scenario baseline.
Yes. They're telling Wall Street that even if oil stays this expensive, they will still deliver top-tier profitability.
And if oil drops, they'll blow past the high end of their own estimates. That is a massive flex.
They can only do that because their demand forecast is so bullish. Q4 yields are already tracking up an astonishing 19% year over year.
19%. Though the chief commercial officer said a lot of that is because the deeply discounted money-losing fares have vanished.
Right. Cost harmonization sealed off the basement.
But they also have a plan to lower structural costs, or CSMX, moving into 2027.
CSMX excludes fuel, so it's a clean look at operational efficiency. They're targeting just 2 to 3% growth.
How?
Mostly by retiring 80 older, less efficient aircraft and upgauging.
Spreading fixed costs like pilot salaries and gate leases across a larger plane lowers the cost per seat.
They're also using a barbell fleet strategy for peak travel seasons.
Explain the barbell.
One side is brand new, efficient planes that fly year-round to pay off their debt. The baseload power.
Workhorses.
Right. The other side is older, fully paid-off planes. They sit idle in the winter, costing nothing, but fire up during the summer rush when yields are high enough to cover their terrible fuel efficiency.
That flexibility is huge, especially with the FAA extending flight caps at hubs like Newark and Chicago.
Since they can't physically add more flights, the only way to grow is bigger planes and higher yields.
The government is basically forcing structural discipline on them.
Exactly. It prevents airlines from oversupplying the market and destroying their own pricing power.
Okay, so what does this all mean for the bottom line?
Let's look at the balance sheet. They proactively raised $3.7 billion in cheap debt at around 5%.
Why raise debt if you have liquidity?
It was an insurance policy against a catastrophic oil shock. But since things stabilized, they're using it for refinancing arbitrage.
Meaning they're using the cheap 5% money to pay off older, much more expensive debt.
Yes, including legacy pandemic loans. This fundamentally cleans up the balance sheet.
And the CFO said this puts them right on the precipice of an investment-grade credit rating.
Which is the holy grail. It unlocks trillions in conservative institutional capital, driving down their borrowing costs forever.
And they're targeting a 75% free cash flow conversion rate by the end of the decade.
So 75 cents of every operating profit dollar becomes pure, unencumbered cash.
That means massive stock buybacks or dividends down the line.
Which brings me to my verdict. I take a strongly bullish stance on UAL.
The thesis being that economic gravity always wins.
Exactly. Inflation is drowning the budget airlines, but United's brand loyalty and premium shift have built a durable economic moat.
So if you hold it, this is a strong core position. If you're on the sidelines, UAL is proving it can navigate shocks better than almost anyone in the industrial sector.
They're executing flawlessly right now.
Well, thank you for joining us for this quick, targeted deep dive into UAL's earnings.
But before we go, I want to leave you with one final provocative thought.
Let's hear it.
If United Airlines successfully transitions its core customer base from seeing flights as a commodity to seeing them as a premium lifestyle brand, will we eventually see Wall Street value airline stocks at multiples traditionally reserved for the tech or luxury sectors?
Oh, wow. No, that is the multi-billion-dollar question. We'll have to keep watching the tickers to find out.
Catch you next time.